Somewhere in Australia today, someone earning $45,000 a year is following the exact same financial playbook as someone earning $180,000. That is a massive problem because a strategy that makes perfect sense at $45,000, like chasing every government incentive and aggressively paying down debt, becomes a missed opportunity at $180,000, where tax minimization and investment structures should be doing the heavy lifting. The advanced moves that save a high earner tens of thousands of dollars are either unavailable or completely irrelevant if you are still building your foundation. Your income level determines your best next move, and most people get this wrong. To make the right choices, we first need to understand Australia's tax brackets. You pay nothing on the first $18,200 you earn. From $18,101 to $45,000, you are taxed at 16 cents per dollar. Between $45,001 and $135,000, the rate jumps to 30 cents. From $135,001 to $190,000, you are paying 37 cents, and anything above $190,000 gets taxed at 45 cents on the dollar, plus a 2% Medicare levy on top of everything. If you are earning under $50,000 a year, your number one priority is building a financial floor beneath you. That means keeping an emergency fund of 3 months of essential expenses in a high-interest savings account. This single move stops you from going into debt when life throws a curveball. At this income level, the government actually wants to help you build wealth through specific incentives. The first is the super co-contribution. If your total income is $47,488 or less, and you make a personal after-tax contribution of $1,000 into your super, the government will match it with up to $500. That is an instant 50% return on your money. There's also the low-income superannuation tax offset. If you earn $37,000 or less, the government will refund up to $500 of the tax paid on your employer's super contributions. These two tools alone can add tens of thousands to your retirement balance over time because of compound growth. At this stage, debt is the silent wealth destroyer. If you are carrying credit card balances or buy now, pay later debt, use the avalanche method. List your debts from highest interest rate to lowest and throw every extra dollar at the top one while paying minimums on the rest to save the most money in interest. If you are earning between $50,000 and $100,000, you're in the leverage zone. You have enough income to make meaningful moves, but you are not yet in the higher tax brackets. This is where salary sacrifice becomes your best friend. Instead of receiving all your pay as take-home income, you direct a portion of your pre-tax salary into your super fund. That money gets taxed at just 15% inside super, instead of your marginal rate of 30% or more. The concessional contributions cap is $30,000 per year, which includes the 12% your employer puts in. If you did not max out your concessional cap in previous years and your total super balance was under $500,000 on June 30th of the last year, you can carry forward those unused amounts for up to 5 years to claim a larger tax deduction. This is also the range to consider the First Home Super Saver Scheme. You can make voluntary contributions into your super of up to $15,000 per year and $50,000 total, then withdraw those contributions plus deemed earnings to put toward a home deposit. Investing outside of super should also start here. Even $200 a month into a diversified Australian ETF like VAS or a global option like VDHG starts compounding seriously over 10 to 15 years. When you are earning between $100,000 and $150,000, the game changes. You are firmly in the 30% bracket and approaching the 37% bracket. Every extra dollar of taxable income reduction has a real impact. Salary sacrifice remains essential, but you must also look at your deductions more carefully, including work-related expenses, self-education costs tied to your employment, and home office expenses. At this income level, private health insurance becomes a strictly financial decision. If you earn over $111,000 as a single or $222,000 as a couple, and you don't hold private hospital cover, you will pay the Medicare levy surcharge on top of the standard 2% Medicare levy. This surcharge starts at 1% and goes up to 1.5%. In many cases, a basic hospital policy costs less than the surcharge itself, meaning you actually save money by holding the cover. This is also where you start thinking about investment structures like property investment using negative gearing. When you borrow to invest in property and the costs exceed the rental income, that loss offsets your taxable income. Furthermore, if you hold investments for more than 12 months, you get a 50% discount on any capital gains, so timing your asset sales matters immensely. Finally, if you are earning $150,000 or more, you're in the territory where every strategy needs to be deliberate and coordinated. At $190,000 and $1 and above, the government takes 45 cents of every extra dollar plus the 2% Medicare levy. Reducing taxable income is non-negotiable. Maximizing your super contributions through salary sacrifice is essential, and you should be hitting the $30,000 cap every year while utilizing carry-forward provisions. You should also look at spousal contributions. Contributing to a lower-earning spouse's super can trigger a tax offset of up to $540 while balancing your household's retirement savings. Beyond super, high earners should explore investment bonds, which are taxed internally at a maximum of 30% and become completely tax-free after 10 years if you follow the 125% contribution rule. Family trusts can also be used to distribute investment income to family members in lower tax brackets. Franking credits from Australian shares are another excellent tool. When you own shares in companies that have already paid corporate tax, those credits flow through to reduce your personal tax bill. The single biggest mistake high earners make is lifestyle inflation. Earning $200,000 means nothing if you're spending $195,000. Set a savings rate target of at least 20 to 30% of your gross income, automate it, pay yourself first, and let time do the heavy lifting. Wealth is not built just by earning more. It's built by keeping more of what you earn and putting it to work in the right places.